Differential computation. As we progress through the combination process, we need to lay the groundwork for a few things to get us moving forward. The first is the differential computation, which we're going to use throughout the semester, and it's going to help us identify what is goodwill and excess fair value over book value, so that when we do some journal entries and starting in Chapter 4, it'll be easy to identify things. The first thing we're going to start with is fair value of consideration. It is going to be the purchase price paid by the parent plus any non-controlling interest. For now, we're not dealing with non-controlling interest, so whenever we drop a number in for this, this will be 0. So it'll be purchase price some number plus 0. We'll then take the fair value of the net assets. Why the fair value? Well, remember from Accounting 1, all the way back to Accounting 1, when we buy something, or when the other company sells, the sub sells, do they sell at the book value of those assets? Or do they sell at whatever the actual price they could get for it today, the fair value? They sell for the fair value. So whenever we go to buy a business, we're going to buy the assets at whatever the current market price is, the fair value. So we'll need this. And the difference between the fair value of consideration and the fair value of the net assets is going to be goodwill. And then lastly, we're going to get the book value of the net assets, and the difference between the fair value and the book value, we'll refer to it as the excess fair value over book value. You're going to need to know this differential computation. We are going to do it quite a bit. We'll practice it enough that, again, this will be second nature by the time we get to the end of the discussion in Chapter 7. Another thing we need to identify is in the previous slide, I mentioned fair value of net assets and book value of net assets. Well, what is net assets? Well, if we take the basic accounting equation here, assets equal liabilities plus equity. We move the assets over, we get assets minus liabilities equal equity. Another word for assets minus liabilities is equity or net assets. So you're going to need to identify the net assets at their fair value and their book value. In this example here, we take the assets, 2100, minus the liabilities to come up with 1300, and we also take the equity and it comes up to 1300 as well. But with this information in hand, let's see if we can compute a differential. Look at this example here. You're giving Roboto is acquiring all the assets and liabilities of Colonel. And what they're going to do is issue 15,000 shares of $5 par value stock. And Colonel is willing to accept that because the fair value of the stock is $54 a share. And then we also see we have Colonel's book value of assets and the fair value of their assets. We can compute the book value of net assets and the fair value of net assets. So let's compute the differential. We compute the purchase price by taking the number of shares that were issued times the market price. We get $810,000. We go back to the schedule and we can see the fair value of the net assets is $748. Now the question becomes, why would someone be willing to pay $810,000 for assets that only are worth $748,000? The difference is referred to as goodwill. This is the name that the company has built, their reputation. Whatever they're good at doing, that would be goodwill. And then the second thing we're going to do is we're going to compare the fair value of the net assets with the book value of the net assets. That leaves us with an excess fair value over book value of $275,000. That gives us a total differential of $337,000. We'll come back to this differential in Chapter 2 And we'll focus on these differences more specifically when we get to Chapter 4. But you need to know how to compute the differential as we move forward. Well, after we compute the differential, we're left with recording journal entries for Robato's acquisition of Kernel, and then we'll look at the journal entries for Kernel selling their assets. I didn't give you this information in the slide, but we have merger expenses of $56,000, and anything that is related to the merger itself will be an expense. So we'll debit merger expense and credit cash. And then any stock issuance cost relating to issuing the stock to Kernel, we're going to put into an account called deferred stock issuance cost. This is a temporary holding account that will keep track of all our costs, and when we get done issuing all the stock, we'll jump down to entry 4 and reclassify that to paid in capital common stock. So the end result is any stock issuance cost is a direct reduction of paid in capital common stock. It is not an expense. The next thing we see is journal entry 3, where Robato is recording all of the assets that they received. And they're recording them at the fair value. Again, remember, we discussed earlier, what value does someone buy something? The fair value. They bought cash, inventory, land, building and equipment. And notice I did not record accumulated depreciation. I put that there intentionally to let you know, again, we buy assets at the fair value, not at the book value. And then we see a patent that was there, and then we record the goodwill that we purchased. And then the last thing we do is we're going to credit common stock, and that common stock is going to be 15,000 shares times the $5 par value. And the difference goes to paid in capital common stock. We're done with the journal entries for Robato. Let's look at what Kernel does. Kernel is going to remove all of their assets, crediting the assets, debiting the liabilities, and then what they're going to end up with is an investment in Robato for the $810,000. That's how much money Robato gave them. So we'll record that as an investment. The only thing that remains after this journal entry 1 is a debit and investment Robato for $810,000, and then the equity of Kernel. Again, remember we sold all the net assets. So generally what will happen is we'll liquidate the company, and to do that we'll credit investment Robato, debit the equity accounts, and what will actually happen in practice is this will occur, and then the shares of Robato stock will be issued to each of the Kernel shareholders in whatever proportion they owned before the sale took place.